Germany has slipped into recession as consumer spending narrows. Output in Europe's largest economy dropped 0.3% in the first 3 months of the year, following a 0.5% contraction at the end of 2022. Also, investors from 21 nations have now been exempted from angel tax. US, UK, France are on the list, but there is no exemption for Singapore, Netherlands or Mauritius, all major sources of FDI into India. We're also tracking aviation sector, where aviation regulator DGCA has asked Go First to submit a revival plan within 30 days. The airline had told DGCA that it would not be coming up with a strategy to restart and will not be committing to a timeline until the moratorium period ends. And banks will be notifying Income Tax Department about large cash deposits of 2000 currency notes above a threshold, and that essentially means that there will be IT lens on those who are depositing 2000 rupee note very, very frequently. All that and more on this bulletin. Joining me at this point in time in the studio is my colleague Karthik Malhotra. Also joining us is Rakesh Khar. I will come to you first, Karthik. Friday, finally, good for us, but not so much for Germany. Germany is waking up to a rude shock. It is now the largest economy in Europe and in recession.
Absolutely, Shweta. And Germany was still very confident till even about a month ago, saying that it will tide over this difficult patch. Now, remember, when the Russia-Ukraine war had started, inflation was the biggest worry for all economies across the world. But Germany somehow had insulated itself because its dependence on energy from the Russia-Ukraine region was always low. And it being an aging population and a small country, energy bills, import bills were never very high for Germany. Yet, what perhaps it did not factor in was the inflation that comes on account of global supply chains. And Germany saw a 7.2% inflation, and that led to contraction in 2 consecutive quarters, 0.5%, 0.3%, and 2 consecutive quarters of downward growth, negative growth, is pretty much the definition of recession. And here it is. Now, the finance minister of Germany is quite optimistic, and in fact, he's come on record to state that there is going to be a possibility of them turning the corner. And what he's really betting on and trying to encourage industry through his statement is that we've got to get our competitive spirit back. We've got to get our mojo back. Germany has been a country which has been known for its auto sector. The likes of Mercedes, BMW, Audi, Volvo, Volkswagen. It's pretty much, the hub of any revolution that has ever happened in the world of automobiles. From pretty much the world's first people-centric car, the Volkswagen Beetle, to the epitome of luxury across the other brands that I named. And it has always been an export hub for luxury cars and even spares, engines, etc. for the smaller cars. And yet it finds itself in a state where actually auto sales had dropped by about 1/3 in the financial year that just went by. So difficult time for Germany, but what is the cascading effect that we should look at? People were assuming US is going to be next, but US surprised us yesterday. There's been a growth, very slight, 1.3% quarterly growth, but a growth nonetheless.
But a growth, yes.
Would UK be the next one to fall off the block? And how long is US also going to be able to sustain its growth, given the overall scenario around Fitch not being very comfortable with this prolonging debt ceiling talk between the Democrats and the Republicans? And now apparently the deficit between their negotiation between the Democrats and the Republicans is about $70 billion, right? So $70 billion in cost cutting or $70 billion in increasing the debt ceiling, either way. The deficit margin right now is just about $70 billion. But X date is what, just about 4 working days, 5 working days away.
Absolutely.
So,
1st of June.
so if Fitch were to cut US's everlasting AAA ratings and go negative on US, it becomes a problem for the Treasury bonds, and it becomes a problem for the safe haven that US has always been, and for dollar as a currency and the markets as a whole. So this entire sentiment in the West is not looking too good at the moment.
Not looking very good. Rakesh is joining us at this point in time. Rakesh, German recession could have cascading impact not just on European economies, and as we discussed, UK could be next in line, but what's happening in US is also not very promising right now, with talks around debt ceiling, not progressing the way Joe Biden would like them to.
Yeah, morning, Shweta. I'm on the run, so pardon my being, in a green cover. I think, this was expected. The IMF in its January outlook did mention that we are heading for a recessionary framework. It's taken 6 months to reach us there, but overall bad news for India on many counts. Let's remember that, our neighborhood is also in a fiscal ICU, especially Pakistan. And if the European market and also what we're hearing now that Germany has already announced recession, this is bad news on many fronts. And specifically, US, I think has done better than what was expected. I think I don't have the latest numbers, but from what Karthik was mentioning, they're actually defying the projections that have come about. But yes, once the ratings from independent agencies come about and they downgrade the growth parameters, it's compounding the bad news. UK is a little worrisome. You may remember a couple of months ago, UK was under the radar, but they have made some sort of recovery. But overall, the bad news and recession in developed economies puts that additional pressure on developing back. And when it comes to India, our export scenario would further get slighted. And we have seen the numbers are falling. And so, in that sense, uh, at one level, you can take some respite and say that, look, in India, there are no cars available to be, to be bought for a variety of reasons, demand and also, chip prices. And in Germany, car sales have plummeted, retail sales of FMCG products have plummeted. So we are in a relatively happier situation, but we live in a very, very interconnected world. 10 years ago, when we talked about Indian economy, we would still say that, we are a little distant. Now, that entire distance is merged, so to say. We live in an interconnected world. We have dependencies, and the entire U.S., sorry, the Ukraine-Russian crisis is impacting us adversely in more ways than one.
All right. Now, before we move further on our bulletin, I want to quickly also touch upon US debt ceiling, because we've been discussing that. As you rightly pointed out, X day is just around the corner. 1st of June is the deciding date, and there is still a deadlock of sorts. What will it mean for, not just US economy, stock market, but also developing economy like ours?
So, Shweta, anybody you speak to is fairly confident, if not overconfident, that a breakthrough will be arrived at. It's not going to be stalemate forever, and before the X date of 1st of June, there is going to be some sort of a reconciliation, either in spending cuts by the ruling Democrats, or which is being asked for by the Republicans, or some sort of a negotiation in upping the ceiling. Now, remember, US Secretary of Treasury Janet Yellen had also stated a few days ago that it's an old practice which needs to be done away with, of having a debt ceiling, right? You don't really put a benchmark or a numeric value to, I will borrow only this much and no more. So, what India does is a
But
debt
is that
to GDP
a
ratio.
fair practice economically? You borrow as much as you feel like, you keep printing money. I mean,
It has to be a function of your economy.
right. And at the moment, the debt to GDP ratio for US is 130%, which
That's right.
essentially means
That's right.
there's a lot more debt on the
That's
table
right.
as opposed to GDP
But
output.
even India has gone up to 120, 125% of its GDP not too long ago, even 18 months, 20 months ago. We had arrived at a stage that we were well above 100% debt to GDP ratio, which is all right. You're over leveraged, but you also have projects in the pipeline which are going to deliver.
Okay.
So, so as long as there is economic activity on, as long as your engines of the economy in the manufacturing or services space, whichever is your forte, continue to thrive, and there is a robust order book in the private sector, or assured spending on infrastructure, etc., by the government, which is going to yield direct or indirect impact on the economy, you could over leverage yourself. Like
Right.
the example I had given the other day also. You may want to buy a house that costs you 1 crore rupees, but you may have only 10 lakh rupees in your pocket. You would be over leveraged in that sense. Your debt to GDP ratio would be 900%, right?
is correct.
You would be over leveraged, but then do you see income coming your way regularly for the foreseeable future? If yes, you could go ahead and over leverage yourself. So US has no reason to actually worry about investments or order books not flowing into the country, because it has always delivered. And whether you look at Silicon Valley, whether you look at any other sector that US is part of, the retail is a thriving sector. Of course, inflation is going to play a dampener for some time, but that's not going to last forever. And we see these economic cycles go up and down. And yeah, the downward trend is present right now, but yet there is slight growth, 1.3% that we mentioned. So I don't think there's anything for anybody to really worry if we were to believe trends and experts who have seen these cycles earlier. A breakthrough will be met, an agreement, negotiated agreement will be arrived at, and hence, there should not be a negative turn in the US. But does that mean US will still not go into recession? I wouldn't bet very heavily on that yet.
Absolutely, but so far the indications are not looking too bad. It is a growth, albeit of 1.3%. Germany is not looking at a very bright morning. It's 7 o'clock in Germany at the moment.
But even in the
Germans
US,
are going to wake up.
Yeah, so in the US also, you're right now very close to a stagflation. In fact, you are in stagflation, where your rate of growth is much lower than the rate of inflation. So the next logical step when you are in stagflation is recession. So, the trend lines are pretty clear that it is getting there. How slowly will it arrive at that final destination is something that we'll have to wait and watch for.
All right, but Germany, they're waking up to a rude shock of recession, where growth contracted by 0.3% and not looking at very bright future given high energy prices, which have essentially narrowed consumer spending, leading to an overall decline in GDP output.